Good afternoon. On behalf of Thai DC, I'd like to invite you all to an exciting event on legal and tax strategies for businesses. We have an elite panel from Chugg firm, including Satya Iruva and Mengzin, and the panel is moderated by Jennifer Fortney, Executive Director at Thai DC. I do see quite a few new participants today, and for their benefit, I wanted to take a few moments to talk through Thai and Thai DC. As you all know, Thai has its roots in the Silicon Valley. It's probably the largest not-for-profit dedicated to fostering entrepreneurship and has been around for 29 years, now with 61 chapters globally in 14 countries and with over 13,000 members and 3,000 charter members. Thai is all about fostering entrepreneurship through mentoring, networking, education, funding, and incubation. Personally, I've been involved with Thai for over 14 years now, first as a charter member and now as a president. It's been a very enriching journey for not only giving back, but also making a meaningful impact to the local DC, Maryland, Virginia ecosystem. And at Thai DC, we focus on 5 pillars of activity. Thai DC GovCon is all about government contracting, which is all about helping small businesses scale, bringing innovation into the capital beltway. Then we have the Thai DC Angels, which is all about mentoring, advising, and investing in early stage startups. We do have a dedicated pillar focused on Thai diversity and inclusivity. And this includes Thai women focused on helping women entrepreneurs and helping founders from minority races. We do have 2 pillars focused on the next generation of entrepreneurs. TYE, the Young Entrepreneur, focused on high school students, and Thai University focused on the next generation college graduates. At Thai DC, now we have started having in-person events, and we'll have more of them as we progress through this year. And here is a quick lineup of programs for the rest of 2021. Let me quickly share my screen. So we do have a government contracting cohort luncheon just for charter members in July. We do have 2 Thai DC Angels pitches in July and August. We are also having a Thai women event celebrating successful women entrepreneurs later in August. This time we are planning a family event for all Thai DC members and charter members in September. You'll hear more about it in our newsletter. And in September later, we do have another event focused on indirect rates presented by Aronson. And our flagship event, the Thai DC Capital GovCon 2021, is a 3-day event, which is planned for the October 27, 28, and 29. And this is going to be a live event as per our planning now. Hopefully all the members will be able to leverage this particular event, and we wrap up this year in November with the gala, that's just a peek at the events we have for this year. With that, I wanted to hand it over to Jennifer, who will introduce the panel and kick off this event. Over to you, Jennifer.
Thanks, Cindy, for that warm introduction. Good afternoon, everyone, and welcome to today's presentation of Tax and Legal Strategies for Businesses. I'd like to take this time to welcome our esteemed guest presenters and the Chugg firm that they represent. The Chugg firm is a full-service law and CPA firm established in 1985 with the presence in both the US and India. It has 14 offices and 500 plus employees in both countries. The practice areas include corporate law, taxes, audits, immigration, and litigation. They have offices in California, Georgia, New Jersey, Virginia, and New York. I'd like to welcome at this time Satya Yurova. Satya is a chartered accountant from India and a CPA in the US, having 18 years of experience. Satya has been with the Chugg Reston branch for the past 6 years. He specializes in taxes, audits, accounting, cross-border transaction, and M&As. I'd also like to welcome Mensing Choi. Mensing is an attorney licensed in Virginia. Mensing also works with the Chugg firm in the Reston office. Her expertise includes corporate laws, estate planning, and litigation. Welcome, Satya and Menching.
Thank you. Thank you, Jennifer, for a kind introduction.
Thank you, Jennifer. Thank you very much. Before we start, I would like to make a disclaimer here. First, thanks everyone to join the meeting. We are very excited to share the opinions and everything. But what I would like to give a disclaimer here, because the webinar here shall not be considered as any professional advice, and you are encouraged to seek any advice, professional advice, which is specifically for your situation. So the meeting doesn't establish any relationship between the speakers and audience. The information shall not be relied on, but of course you are always welcome to join us in the future, and we would love to help in any matter. Thanks. Go give it back to you, Jennifer.
Wonderful. Well, we have a lot of information I'd like to cover today. So we'll try to get through everything and leave room for questions from the audience at the end of the program. For the audience, please use the Q&A link at the bottom of your Zoom screen to enter your questions. We'll try to answer as many as possible at the end of the program. But let's jump right in right now. Satya, let's start with a basic question about structuring of companies. We know there are a lot of different entities, and we hear the words LLC, S Corp, C Corp, partnership, LLP. There's different types of entities. Do you have any particular recommendation for a company?
Yeah, sure, Jennifer. Actually, this is a correct topic to start a webinar because any entity or any business that one wanted to establish, it starts with choosing the type of the entity. So we'll start it from there. So basically, what happens is for any business, choosing a right type of entity is very important to protect from legal liabilities or to maximize tax benefits. As you mentioned, there are different kinds of entities, LLCs, we hear INCs, corporations, and then partnerships, professional corporations. So just to give a broad level idea, there are two kinds of entities that are suitable for businesses. I'm not going into the details of each and every type of entity, but for most of the businesses, two types of entities are commonly available. It's LLCs, limited liability companies, and INCs. And for tax purposes, we can have some elections, that is S corporations or C corporations. So a partnership entity election or S corporation entity elections, these are kind of a pass-through entities. And from tax point of view, these have S corporations and partnerships have a lot of advantages, and that's a single taxation. There is no tax at entity level, but the shareholders or the members has to pay tax at the individual level. When we go to C corporation, there are two types of taxes that are applicable for C corporation. That is the main kind of a disadvantage, we can say. Entities has to pay tax at entity level, and then when they take out the money as a dividend, then they have to pay dividend tax as well. So these are the main differences from tax point of view. But when it comes to what kind of entity that a business entity the wants to choose, that all depending on some factors, and it is on case-to-case basis. So just to give few example, so someone wanted to start a restaurant business, or someone wanted to invest in real estate, then a typical LLC would be recommended. They can go with S corporations and all, but an LLC would be recommended for a easiest setup. And someone wanted to start some business, IT business, a technology business with employees, then certainly S corporation would be recommended. And in S corporation, there are certain limitations. They cannot have more than 100 shareholders, and the entity cannot be shareholder. So there are some restrictions with S corporations. As long as you meet the condition, then S corporation is also a very suitable business, and most of the businesses choose S corporation status. And some clients of ours, they ask us, okay, when do we go for C corporation? Because as you are saying, it's a double taxation. Then what is the logic to choose C corporation? Of course, there are certain advantages with C corporation as well, though it is a kind of a double taxation, but with the reduction of tax rates now. And there are some other benefits that are associated with C corporation, then certainly we recommend to go with C corporation. And a few examples include, for example, if the company has employees where company wanted to issue stock options, or company wanted to go for some outside investors where they wanted to get some funds, or if you wanted to sell in future, then there are some tax benefits associated with the sale of the business. So considering these factors, we need to decide. Basically, what we recommend for business owners is to act in advance, decide which entity type is suitable for you, and considering your specific nature of the business and your plans for the business in future and growth plans, whether it is going for the investors or selling and all. So this is what I would like to kind of give a brief idea about the entity structuring. And if anyone has any questions, then we can discuss at later point of time after the session is over.
Yeah, that makes sense. And Mensing, from a legal perspective, do you have anything you would like to add, or any kind of whether or not any particular type or entity will protect owners from legal liabilities?
Sure. Thank you, Jennifer. That's really a fantastic question, because I believe one of the most important reasons why people want to establish a different entity is try to separate themselves from the liability, which probably we can see in the future. So of course, there are two main type of entities that separate the liabilities. One is LLC, another is corporation. For the LLC, we call it membership. For the corporation, we call it shareholder. But the key point here is that because they have different separate personality, we call it this. So which means they're separate. So the creditor can only chase after the corporation. But of course, there are some exceptions that I will address in the future later. So, but however, for the sole proprietary and partnership, I mean the general partnership, they do not separate the liability from the the owner. So in that case, the people will need to be very careful about it. But however, in one scenario, when we say limited partnership, so which means the liability is limited, but still will be liable. That's also one of the things that the people need to consider about it. They choose the type of entity. So then the question I just want to address is how to avoid the piercing the corporate veil. So let me back a little bit before. So what I'm saying is, of course, in general rule, they're separate from liability. But however, if you do something wrong, then it still can hold personal liable. So for example, if you have self-interest or you treat your LLC or corporation as your own business, as your non-business, as your own assets, right? You commingle your own accounts with the business accounts. You also do some fraudulent action. In that scenario, which we call it pierce the corporate veil, means that you will not still be personal liable for whatever pursue after you in favor of creditors. So that's the reason from practical side, I believe that we always recommend our listener to make sure that everything is proper conducted, to separate the personal assets and to make sure you are totally separate from the operating of the business. So in that case, there will be no claim from creditors saying piercing the corporate veil. But of course, there's another thing actually I want to address is about the governing document. Of course, when you incorporate or either LLC or corporation, you will need to draft the documents which regulate the policy, the meeting, and all the details or voting arrangement. So in corporation, we call it stockholder agreement, which also regulate all different kind of details. But in LLC, we call this governing document as operating agreement. For the operating agreement, that means that we also will control to make it specific who will do the day-by-day operation and who is all supervising what, and what is the biggest decision decided by whom. So this is a very general introduction from my side. Thanks, and give it back to you, Jennifer.
That sounds great. I really appreciate it. It's actually really coincidental because questions are already starting to roll in, and the question from Anu is a question I have, which is, Can an already existing company change the structure? And if so, Satya, how do you recommend to make that change in the structure?
Yeah, certainly, Jennifer. So the short answer is yes, an already existing business can change the entity type or structure. But the thing is, what's the reason for the change? So I can divide this into two different areas. One is a default conversion. So I'll just give you an example. For example, if you have an entity with S corporation election. So with S corporation election, as I mentioned earlier, there are certain conditions that you need to meet to categorize as a S corporation. Say, for example, the shareholders cannot exceed 100. So that's one of the conditions for S corporation. So, for example, if tomorrow your company exceeds, I mean, your shareholders, number of shareholders exceeds 100, then by default, your S corporation status is terminated and you have to convert that into C corporation. So then this is a compulsory kind of a conversion. And then there is another type, that is a voluntary conversion. If a business has some specific requirements, then certainly they can convert entity to another entity. Again, to give an example, say for example, you have an S corporation or an LLC with partnership status, and your intention in long term is to sell your company, and you are expecting a huge purchase consideration, and you are expecting huge capital gains. So now you can plan in such a way that there is something called a Section 1202 capital gain tax exemption, which IRS provides, where you sell the company and that company has to be a C corporation, and there are certain conditions that you need to meet. And if it is a C corporation, and if you maintain the C corporation status for 5 years, whatever the capital gains that you get when you sell the company, that capital gains are exempted. So this is a huge impact, and it will be huge tax saving. So then in that case, if you plan ahead, you can convert the company from S corporation or LLC or any other type of entity to C corporation and maintain that for 5 years and meet other conditions as well, and to get the capital gains exemption under Section 1202. So this is a typical another example. Again, we have to plan ahead, and there are some other instances where you can convert from one entity to another entity, it all depending on what is your type of entity, what's your growth strategy in future, and probably you can start with with a very small setup, but in future, in next 3-4 years, you are going to be big. Then certainly you can consider changing the type of entity to have a maximum benefits out of the entity. So these are few examples, Jennifer. But again, as I said, like we have to analyze case to case basis, whether it is an existing business or a new business that you wanted to set up. We always recommend to analyze it properly and properly structure your companies, because once you choose the entity type and once you structure the company, it's very difficult to change it to. There are a lot of consideration that you have to consider. So I would recommend to kind of review our audience to review our existing business structure and see if we can get any advantages by converting.
Yeah, I'd imagine there's a lot of things to review. Mensing, is there a certain procedure for converting to the entity structure, or is it just go through the process?
Sure. It's a really good question. So of course, I believe all the different conversion depends state by state. So let us say, take an example, Virginia. I'm a Virginia attorney. So what happened is, of course, normally as the first step, the board of director has to get approval, right? So they have to first think that it's the best interest of the corporation or LLC to decide for the conversion. So basically, they will need a board resolution and also attach what we call a plan for conversion. So in that plan, they have to specify the plan, how to convert and why to convert, and of course the basis from LLC membership interest to shares, which the shareholder will hold. So this is the first step. And the second step is, of course, for the shareholder to approve that plan. And after that, this is all internal work was completed. I mean, according to Virginia law. And then after that, will be filed 2 different forms to Virginia. One is as the application for conversion, which actually we are saying it's the conversion article of incorporation, and also the file article of entity conversion. So these 2 forms need to be submitted and to confirm. So this is the basic, very general introduction about the procedure. But of course, I believe for the other state, they have the similar rules and the procedure for it. And by default, according to the statutes, this kind of approval, if there's no specific, instruction in the governing document, it requires a majority, which is 2/3 majority of the approval. So thank you so much. Give it back to you, Jennifer.
That's great. Thanks, guys. So now that we've established our entity and we've established how we want to run, now let's move a little bit into the employee-related topics. Mensing, what are some of the common employee-related issues, and how do you take care of any potential issue?
Yeah, it's a really huge topic, but definitely I will try my best to reduce it. So basically, at the very beginning, I think everybody will know what is the difference between W-2 and the 1099s, right? The W-2 is for employee and 1099 is for independent contractor. And then the people are gonna ask why there's difference and what's the big deal, the difference. So basically, the difference is for employee side, they're gonna be covered by the number of federal law, state law, and the labor law. They were well protected. But for the independent contractor, the more governing document will be contract, because it's a contractual relationship between the independent contractor and also the company, right? So that's the biggest difference. And then a lot of employers say, I'm fine because I have an employment agreement, or I have a specific contract say we are just independent contractor and there's nothing related to employee and employer. But sometimes it actually can be some problematic way. The reason because sometimes the employer just misclassify the people. So let us say there are a lot of factors to decide whether this person is truly employee or independent contractor. So it depends on the degree of control. So for example, if you fall in all the category, which is like employee and employer relationship, although you specifically say it's an independent contractor, but it still can raise some red flags. So for example, you control the way they work, you control the place, you ask them to come to the office from 9 to 10, etc. You also have the supervising, evaluation, order system, and you also provide the tools, right, and monitoring stuff. So this sounds like employer-employee relationship instead of independent contractor. So that's also the thing that the employer need to make sure they do not misclassify the people. And another thing is because when the misclassification happens, what happened is actually that person is deprived of some rights which is protected under employee, as an employee, right? For example, the lost wage, lost employment benefits, unemployment benefits. These are all the benefits only provided for the employee, not independent contractor. So if you misclassified, this will be some problematic for that. Another thing I would like to mention is about the contract, because I understand that there are a lot of our clients, they are IT companies, so they understand the standard of industry. They don't want people to steal their employee, or when they assign people to work with the end client or vendors, they don't want their employee leave the position. So how to prevent that is for a non-competition agreement or a non-solicitation or non-disclosure. So in that case, there will be a deterrence from employer's side. So the employee will think about it when they want to breach the agreement. But if you don't have that clauses, which means that everyone are at will, so they can do whatever they want, and they can just leave anytime and just directly work with your competitor. But of course, it all depends on the state law. I can frankly say California doesn't like non-competition agreement because it's kind of the terms for the economic development. Of course, for the other state, they also have a very strong restriction of how to draft the non-competition agreement. So I think this is another thing, another way to protect the employer. They can think about it. Thank you so much, Jennifer. Give it back to you.
Well, that's a great way of putting it. Satya, is there any tax or compliance issues that we need to take care of with respect to employees?
Sure, Jennifer. I think there is no tax implication as such that I would like to add in this particular situation, but I would like to kind of give two common issues that we face, our employer or our clients face regularly, and we get calls from our clients. So sometimes we get inquiry from both businesses as well as employees of the business saying that, okay, now I am going to work for this company. So can I be on W2 or do I need to be on 1099, or can I choose between W2 and 1099? I think Mingxin has explained it in a better way. So there is no choice for this kind of a situation. So it all regulated by labor laws of that particular state. And you have once you meet the conditions of employee definition as such as per the state law, then you have to be on W2. There is no choice, and you cannot choose between W2 and 1099. This is one thing that I would like to mention. And second one is with respect to the compliances. So what we mostly see among our clients is so clients is in one state, for example, and they have employees in various states. Sometimes if an employee is added in one of the state, they don't do the employment registration in that particular state, and they keep on processing the payroll in the state where employer is located, not based on where employee is located. So this is one of the common area that we see where there is some lapse in the compliances. So we suggest all the businesses to do the payroll processing based on where your employee is located. You need to take the registration in wherever the state your employee is located, and then you need to process it from there. So these are the two things that I would like to add, Jen.
That's great. I really appreciate it. Well, as we're talking about employees and we talk about, potential equity reward plans or offering stock options, Mingxin, with regards to employees, sometimes we prefer to give stock options to key employees. What are the different stock options and which one is recommended?
Sure, Jennifer. That's a really good question. And I really like the timeline we're discussing here, because we discussed about incorporation and employee development. Now we are talking about how to grow the company and to make the people stay with the company. So of course, at that time, the equity award plan kicks in. So that's also one of the reasons I actually want to relay here. What is the purpose for the equity award? Because sometimes compared to giving, increase the salary, employer will think about why we just issue stocks to employees, make them as a shareholder as well. So in that case, they will have more motivation to stay with us, and of course, consider the company as one of their assets as well. So that's one of the biggest reason why the employer issue, provide the stock, equity award plan. So then next question is what kind of option they have. So there are 4 different primary options. One is RSA, RSU, incentive stock options. Another one is, of course, non-qualified stock option. I know this kind of word is complicated and it sounds very complicated. So we just make a very simple example, one by one. So for the RSA, which is restricted stock award. So which means that the employer actually provide employee to purchase the share at a fair market value. And when the stock is granted, so that employee directly have the shares. However, there are some restrictions on the shares, which we call it restricted stock award. So which means that the employee cannot sell it or transfer it until when the time comes. So basically, in a normal case, the company will ask the employee to stay with the company for example, for 2 years. So which means that if I grant you today and after 2 years, the shares is finally vested. So then the shares, you are able to sell it or transfer it. So this is one option, which we call RSA. For the RSU, it's another different thing, which is restricted stock unit. So this is a very different one because they're hypothetic shares awarded to an employee. So for example, if I grant RSU today to an employee, the employee will directly get the shares as long as they stay with the company for certain required years. So for example, if I say I will grant you a RSU today, but you have to stay with the company for 3 years. So which means after 3 years, that employee will directly get the stock and shares. So another one we call, which is incentive stock options. This is also a very popular concept and a lot of clients ask. So it is a company benefits that grants an employee the right to buy common stock at a preset, or we can say a discount price. So, and also with tax advantage. So in that case, the ISO are issued on the beginning day, which we know as the grant day we just mentioned. And then the employee has the right to exercise his right to buy and of the option in the future. So because there's tax advantage, so to grab the tax advantage, they have to receive, the employee must hold the shares for both either 1 year from the date of exercise or 2 years from the grant date. But of course, the rules change from time to time, but this is the general key point for the ISO. The last point, I just make it very short. The difference between, this one, which is non-qualified stock option, and ISO is compared to ISO, it's unqualified, so they can be issued to independent contractor, non-employee directors. But however, for the other stock, which is ISO, it only can be issued to the employees. So that's the main difference between the 4 tabs. I know it's kind of overwhelming, but you are welcome to come to us if you have more questions. Give it back to you, Jennifer. Thanks.
Yeah, I have to think that, while we're giving some really high level, points of strategies that, again, we would say, obviously there you can follow up with more, specific questions to your needs based on your company's organizations. And I have to think if you're going to offer up stock that there has to be some tax implications, Satya. So could you share if there's anything that is going to help the organization by doing this?
Sure, Jennifer. So generally, as Mengzhen has explained, 4 types of typical stock award plans. And one important criteria for choosing a plan for a business is a tax implication for both employees as well as employers. So out of the 4 plans that we discussed, so there are few plans where it's more tax favorable, and a few are not that tax favorable. So in the example that Mengzhen has mentioned, ISO is the incentive stock option, is most tax favorable stock option. And this is chosen by the companies where it's full kind of a established businesses. And under RSUs also, restricted stock options also, stock units also is kind of a bit of tax favorable stock options. And businesses can choose between ISO and RSUs typically. And when you come to the topic of what plan that we need to choose between these 4 different kinds of options, it all depending on the business type and where you are at the business. Are you a startup, or are you a established business, or what is your plan in future? So this is all depending on a lot of variables here. And typically what we see among our clients and what we see generally in the industry is a lot of startups are preferring RSUs mostly, and some established businesses they plan to go with ISO. So this is what the trend that we see in the industry. And when it comes to tax implications, as I said, like ISOs and RSUs are most tax favorable. I don't want to go into the details of tax implication as it is, but just to give a broad level idea, for ISOs and RSUs, typically capital gains tax that is applicable when you sell the stock. Then it's the difference between the sale price and the exercise price. That is what you need to pay capital gains tax on it. And then if we go with non-qualified stock option or restricted stock awards, then there are two different kinds of taxes that are applicable. One is ordinary tax, ordinary income tax, and then capital gains tax. So again, to give a broad level idea, so ordinary income tax rates that are applicable when you exercise the stock option, the difference between the exercise price and the market value, that is what you need to pay ordinary income tax. And when you sell it, then you need to pay capital gains tax. So this is the main difference between these different types of stock option. And you can one can avoid or one can minimize the taxes. There is something called Section 83B election. Typically for non-qualified stock options or restricted stock units, you can elect 83B election, and then you can minimize some of the ordinary income tax. These are at a very broad level. Again, this is a very complex and detailed topic. So if any specific question, we can address later.
Understandable. And then staying along these same lines, if we talk about potentially mincing about offering up stock option to investors, what do we have to consider for that?
Sure. So if we are referring to issue stocks to investors, because investor of course make the contribution as for the cash flow and all the stuff. So there's a one thing that back to the very beginning we want to discuss is make sure everything is done properly at the very beginning. So when you want to issue the stocks to the investor, we highly recommend that all the people has to first look back the governing document and to see whether they're allowed to issue the additional stocks to the investor, and how to get approval at least from the shareholders or from the board of directors as well. So this is the governing document that as always has to look for it. The reason is because when you ask somebody to invest the money, definitely there are some legal documents between, right? So in that case, there also will be some warranty and representation saying the company is allowed to have the investors and allowed to issue additional stocks. So this is the one thing that we have to make sure at the very beginning as the first step. And the second step, actually, there's also a very popular concept which we call it convertible notes. So for the convertible notes, you can see the name of it, the notes, which means it's a short-term debt. So the investor can loan the money to a startup as its first round of funding. But then instead of getting the money back with the interest, what they choose is they want to receive the shares of stocks as exchange. So of course, the pro here is it can be fast, it can be simple, and also delayed valuation, because there will be no need for valuation or evaluate of the company at that point. And until the future, then they can evaluate the company. So they of course will be able to push back the date of valuation exchange for governing early investor a discount in the security. So that's what the investor like as well. And also the startup also don't need to worry about how do we pay them or whether we have any promise to pay them with interest, etc. Another thing that we always recommend to our client is to shareholder agreement. Because when the investor came in and they are issued shares, then they become shareholders. So in that case, the company has to make sure the shareholder agreement are specifically saying that the obligation. So in that case, everybody are on the same page, specifically for the voting arrangement, right? Because sometimes the investor can be just the passive shareholders. They don't want to vote or they don't want to control. They just say, we just invest and we are receiving the benefits in the future. So this is all depends on the situation your company is in. So in that case, you will make more precise decision regarding that. Thank you, Jennifer.
That's great. And then of course we would want to, on the other side of it, Satya has talked about the taxation work with that.
I'm not going to talk about the taxation as such, but the convertible when the startups take loan and they wanted to convert or they wanted to issue convertible notes. So the two main things that they need to consider is what is the valuation and what is the discounting rate. Typically, what we see in the startups is that this happens in seed round funding of the startups. So when they take loan from some of the family and friends, and they wanted to issue convertible notes, then what is the valuation that they are going to value this convertible note in order to issue the stocks, and what is the discounting rate. So after 1 year or 2 years, if they see the valuation of say 10 times, then that is the base of the valuation for issuing the convertible note. And then on the valuation, they need to do some discounting. And so based on these two things, the number of shares are decided when they wanted to do the conversion. So this is kind of again a specific area where we need to and it is again specific to each business separately. So we need to look into the circumstances of the case and decide what's the valuation and discounting rate, and then decide on the stocks.
That makes sense. Definitely makes sense. All right, well, let's shift gears a little bit at this point, and let's say we've gone through all this, we've grown our entity, we're offering up stock options, but now we want to look at a merger or an acquisition and transaction. So, Min-Sing, what are some of the key issues that we need to think about when we start entering into that?
Sure. So, of course, when a client approaches to us, the first question we want to know is whether you're a buyer or seller, because the different rule depends on also you're very different. So because for the seller, we need to make sure that the client will be released from the liability, right? That the liability will be clearly specified in the agreement. And of course, in agreement, there will be a lot of representations and warranties saying there's no pending litigation, everything is fine, the governing document is ready, and there will be no breach of contract, etc. So this is from seller side. We have to make sure that we are on the right track. But for the buyer side, of course, they are the people putting the money, and they have to make sure that all the things like due diligence is properly done from the attorney side and from their side. They want to know they're really making the right big decision and making the right valuation of the company. So this is the first question, which is very important, and also focus on different area. And then the second step will be letter of intent. So the letter of intent, basically, you can know what it is it's a basic, primarily it's a letter sent from the buyer saying, hey, we are interested in buying your company, and this is the structure, and this is what we offer. But basically, letter of intent also kind of negotiate between the parties, and finally reach up to become one on letter of intent, which is the basic structure reflecting the payment arrangement, the warranty, and how to conduct the due diligence, etc. So after that, it will be due diligence. The due diligence is, which means the buyer has time to do the research about the company, because at the very beginning they had a talk with the seller. They kind of know what the company it is, but then they have to look into it and to make sure everything is really worthy the money, right? So in that case, the due diligence also is a very important part for conducting And also if there is a pending litigation or if there is a pending invoices that failed to be paid. So in that case, they also has to be specified in the agreement. So what if there's something wrong in the future, which we don't know when we do the due diligence or it's not disclosed to us, then how do we do that? So then they will probably have indemnification clauses saying if there's anything, then the seller has to be responsible because you don't tell us that and do not disclose us to that. So then you have to be responsible, something like that. So this is the basic, very general procedure for the merger and acquisition. I cannot just describe in 3 minutes, but this is just a general idea about it. Thank you, Jennifer.
And they take a while. So it's not like they just happen overnight. I know that. There's lots of preparation that has to happen before it, during it, and after. Yeah. So Satya, is there any tax implications or how does taxation work with an M&A?
Yeah, sure, Jennifer. So in any M&A transaction, tax is one of the main and important aspect that especially seller need to look into. So what I will, there are a lot of topics that we need to discuss in M&A when we discuss about M&A topic. So, but I will touch upon two key issues. One from buyer point of view and another one from seller point of view. From buyer point of view, the main thing is the financial due diligence. So when we start doing the due diligence, there are some key aspects that we need to look into in seller's business, their financials, tax returns, and valuation calculations, and then compliances, especially whether seller is compliant with all the taxes, including payroll taxes. What we see typically in M&A transactions in financial due diligence, there are some surprises which even seller doesn't aware of about it. So due diligence is one of the main thing that I would say from buyer point of view. And then second, when we look into seller point of view, then if especially when the seller is going to sell it for a material consideration, then certainly capital gains tax is one of the things that he needs to look into it, and he has to plan in advance. And when I say capital gains tax, then generally whatever the sale price minus the cost that is involved, the seller has to pay capital gains tax. And the second important thing in addition to the capital gains tax is how the seller is allocating the purchase consideration between the assets. So that's very important because once he allocates purchase consideration for each of the asset, then that is going to be the basis or cost basis for the business in future. And the accounting treatment or depreciation or the writing off is all depending on how the purchase consideration is allocated to each of the assets of the seller. So these are the two things that a seller need to consider, and buyer, of course, it is for the having a good due diligence of from financial, legal, and immigration, if at all they have immigration aspects of it. And these are the three areas that a buyer need to look into it.
Wonderful. So we're coming up here. We have 10 minutes left. We probably just want to cover a couple more questions and then try to answer any questions that might be in the Q&A that we can address directly. So here we come into the last sort of questions here. I have from Min saying, companies, like, again, moving over to something slightly different here, companies that have issues with collections and accounts receivable, do you have any tips from a legal side for the companies, and what are any practical issues?
Sure. Debt collection is definitely one of the most important topic that a company, if they grow, they definitely probably will experience. So what happened is, of course, the first thing I will advise is how to avoid it. So basically, for how to avoid it, which I mean that from our side, the best way is to make sure the contract, if you get a chance to draft the contract, you have to make sure the contract is properly drafted. I also specify the obligation, the term of payment, and of course, for the governing law, which is one of the most important part, because for the governing law, which means that how and where the case gonna be filed. So this is the one thing that the client will want to know. The second thing is when you have a debt collection issues, then you have to decide case by case. For example, how much for the amount of the debt, and what is the status of the opposing company. So let us say if they are in the pending invoices, they just don't want to pay. So in that case, it's fine because you still can pursue after them. But if they are suffering a very difficulties, financial issues, which means that probably they're facing or towards the bankruptcy. So in that case, the company also will think about whether it's really worthy to claim for it, or we have to act very quick because once we get the judgment, we still have to enforce the judgment. So if that's the case, when they file bankruptcy, there will be jeopardized the debt collection. The last part is for the procedure. So basically, if it's a small amount of the debts, then it can be filed in. Take an example, take Virginia as example, they can be filed in general district court. But if it's a big amount, like more than, let us say 20,000, it can be filed in circuit court, which is a quicker, but also have more procedure for it. So this is all the factors that a company need to consider. Yeah, thank you, Jennifer.
Yeah, that's great. That's great. So, moving to slightly a different train of thought here in working with, multi-state corporations. Satya, maybe you could address quickly, I know we're coming up on the top of the hour here, but there's lots of businesses, including in our own Metro DC area, in which we do business in multi-states or setting up businesses in other states. If you could address some of that quickly, and then again, we're going to share your information, your contact information, so people can follow up with questions to you directly if we don't get to them during this event.
Yeah, sure, Jennifer. So we know like we have a lot of businesses where they have presence in multi-states. So just to give it a short kind of a compliance requirement for these kind of businesses, what I would say is to have a compliance and requirements to be analyzed for each of the state. Just to give an example, income tax, right? So some businesses may think that, okay, if they incorporate in one state, there is no requirement of filing the income tax returns in other state. But it is not the case. If you have a customer or if you have employees in other state, you may need to file income tax returns. So there are three things that one business needs to consider is nexus. So a business has to have nexus. Nexus is defined differently for each state. So as simple as if a business has any employee or office location, or in some cases even customers in one particular state, then business has nexus. So if nexus is established, then business has to file income tax return in that particular state. Then after that, the second consideration is, okay, now I have employee, but do I need to file income tax return in other state? The answer is yes or no. It all depending on your sourcing rule. That means that the particular state some states say that, okay, if you have employees, then whatever the revenue that you derived from that employees, you pay tax on it. Some states say that, okay, irrespective of where your employees are located, if you have a customers in my state and if you derive revenue from my state, then you pay income tax in my state. So these are the rules that you need to look into, and there is no one fixed criteria for this. You need to look into each state rule, and you need to be compliant with the state.
Yeah, that makes sense. Oh, it's just very complicated. I can only imagine what it would mean to do something internationally connected. I mean, I'd imagine that's a whole nother set of things that we probably don't have time to cover on this particular 1 hour session.
That is 2 hours webinar.
That's a whole nother one.
Yeah.
That's part 2 of this. Okay, so let's just, as we wrap up here, it's 12:56. Do you want to talk quickly about, Satya, if there's any future or potentially new tax proposals that are in place that could potentially impact organizations as they start to prepare?
Yeah, Jennifer. So new tax proposals are in place. Biden administration is working on it. I will mention 3 key areas where businesses and individuals are going to be affected. I'm not touching upon international taxation and all, but US businesses. One is corporate tax rate. C corporation tax rate, presently it is 21%, and the tax proposals have it for 28%, so bringing that to 28%. So that's one area. And the second, capital gains tax rate. So for the business, for the individuals with income of more than $1 million, the long-term capital gains tax rate is they levy based on the individual common tax rates, not the long-term capital gain tax rate, which is favorable. If this passes, then for certain individuals, this is going to be a huge impact, and they need to pay capital gains tax at the rate of their ordinary income tax rates. So that's another change. And the third change is in respect of the estate planning, or I can say gift tax exemption. So presently the limit is $11.4 million per person for a lifetime. And now the administration is planning to bring it down to pre-Trump year of 3.4 million or something like that. So these are all, again, activities is that these are all in proposal. We don't know what is going to be passed finally. There may be some changes, or there may not be some changes, so we don't know. But I see these are the critical areas.
Yeah, it's great too. Well, we've gotten a lot of questions, and I know we're running out of time, so that if we don't get to your questions today, we will have them and we will follow up with everybody. And if you guys want to go ahead and quickly drop your contact information into the chat, you just hit panelists and attendees. That way they have your information, they can follow up directly too. So as we think about ending today, do we have, Minsing, do you have any provide any best practices for businesses as we close up to today?
Sure, yeah, I will try my best to wrap up the points, and if possible that I will probably add some new. So I will separate into 2 categories. One is internally and another is externally. So for internally, keep updated for employees, employment agreement, employee laws in the state where you're located. That's really important because, of course, the employee are really valuable assets of the company. And also update the employment policy and employment agreement with the development of your company. So sometimes when a company is startup company, they don't have a lot of contracts with the other people. They don't think about non-competition. But when, with the growth of the company, then they're thinking about how to keep the employee, right? And another thing is keep efficient communication with the employee, especially when employee filed a complaint. So and then the HR role kicks in. Really important. They want to do a due investigation. They want to know what's going on and also have a very efficient and amicable talk with the employee as possible. And of course, if employee decided to leave voluntarily, or if there's a misconduct there, the company should have the records for it. So in that case, there will be unemployment benefits not qualified for them. Of course, there will also another impact on the employer. And for the externally, all important decisions shall be made right at the right first place. So let us say if you have the governing document specifically prohibits you from doing something, except you receive all the consent, unanimous consent of the shareholders, then you have to follow that. Otherwise, all the action is voided. Another thing is, even you enter the contract, and then you have to represent and warrant that all the thing you have authority to enter, and there's no obligation or violation. So that's also one of the things that you need to make sure. And otherwise, for the debt collection, never ever delay on debt collection, because there is also a statute of limitation. The rationale behind this is court doesn't like people sleep on what they're entitled for. So let us say in Virginia, the written contract is 5 years. So which means that if you fail to file a lawsuit within 5 years after you find a breach of the contract, you will never ever get the money you are entitled to. So this is another important tip for the company to understand. and also have a very systematic debt collection way. Thank you so much, Jennifer. I think that's all I want to wrap up.
Wonderful. And then Satya, from your perspective, can you provide any best practices from the tax or other compliance issues here as we wrap up today?
Yeah, sure. So again, I'll summarize whatever we have discussed during last 1 hour. I would recommend to businesses to review their entity structure and see if there any requirement of converting or change of the entity structure. That is one thing. And tax planning. So generally what we see is, so our clients approach us at the end of the year or the beginning of the next year and ask us, okay, can we do something with regard to the tax planning? What I would recommend businesses is to plan ahead and tax planning during the year itself. So we are already halfway through the 2021. So review your finances and review your income and see what are all the tax implications that you are going to have, and plan accordingly before end of the year itself. So that's the other thing that I would like to advise. And then when you have multi-state businesses, look at the compliances that you need to take care of in all the states where you have the business or where you have employees and customer, whether it in terms of income tax or sales tax. So that's the third thing. And then payroll related. So what we see a common issue among our clients is if someone hires employee, then they do the registrations in the state and they do payroll processing. But when the person leaves, then if they don't have any requirement, they forget to close the registration. So this is one area where business owners need to look into and close the registrations wherever you are not active. And then last one that I would like to mention, which we haven't touched it. So when the entity is a C corporation, then there is always an issue when you infuse funds in the company, that is debt versus equity. So there are certain IRS regulations with regard to it. We need to be a bit careful about it. So these are the points, Jennifer, that I would like to kind of summarize.
Well, that was great. Yeah, and I know we didn't get a lot of the Q&A at this point, but what we're gonna do is we'll download these. We'll actually go offline, answer them, and then send them out to everybody, as well as provide a link to the recording in case you missed any part of it or wanted to review any part of it in our discussion today. Well, I would like to take this opportunity and thank both of you and Chug for providing us a very, very detailed and high level experience on some strategies for both organizing an entity, and also what we can do to help keep our employees and also deal with some of the structure that we need to take care of. So thank you so much for joining us today. And I look forward to you guys presenting again in the near future, and maybe we'll do one on an international flavor of how to work both with companies domestic and abroad.
Thank you so much, Jennifer. Thanks for the opportunity. Very nice.
Thank you, Jennifer, and thank you all the attendees. Jennifer, I mean, if we have some time, can we address 1 or 2 questions, if that is okay with you?
Sure, if you'd like to. Yeah, that's great. We can, if you want to
I see
go over
1 or 2
minutes.
questions which are kind of a there is one question from Nimble Hub. Are there online tools that can help small business manage sales tax filing if selling to multiple states? So this is one interesting question. Yes, there are some online tools that are applicable. I know that there is some SalesJar and other online websites are there to manage sales tax filing compliances. But what I would recommend is it's not that when a business sell products to one particular state, it is not that you have to compulsorily file sales tax return in that particular state. You need to have nexus in order to establish filing requirements. So what I would recommend is the company or business is to review the requirements of nexus and then only file the tax return. Otherwise, just merely selling products to one particular state, there is no requirement of filing sales tax return. You need to analyze and then do the filing. So that's what I would recommend in this case. And I believe there are a few questions regarding the Anu, some question from Aru, where do you recommend to incorporate and why? So this is a very general question. We need to look into your business type and who are the shareholders, and whether you have business establishment already in the state, or if you have employees in the state. So it all depending the state of incorporation. It all depending on a lot of factors. We need to analyze your specific situation, and then only we can advise. So yeah, another question from Nimble Hub. We are tech company and started as a LLC to keep things simple. Is there a rule of thumb on when to transition from LLC to a C Corp, so you can take tax benefits of planning for a future sale? Yeah, so yeah, this is again interesting question. We know a lot of businesses, they start as a very small, and they wanted to keep the things simple and establish LLC. But C corporation is an election. If in order to get the tax benefit of 1202 capital gains tax exemption, it's not only that you have to maintain C corporation status for 5 years, so you have to meet certain other conditions also. So we can discuss that in detail. It needs a proper planning. So you can contact us by sending an email, and we can discuss offline. So I think these are the few, Jennifer, I think probably we can.
That you can answer now. Yeah, that's great. Well, again, thank you both for joining us today and sharing your knowledge and your expertise. It was very enlightening for all of us.
Thank you, Jennifer, and thank you, TIDC.
Thank you, everyone. Thanks.
Thank you.
All right. Bye all.